Good morning, everyone. I hope I'm
Good
audible
morning,
now.
Kusum.
Yeah.
Yes. Good 1 minute, Kusum. Good morning, everyone. I welcome the speaker, Ms. Mythili Mr.Arun and Mr. Arun Kumar for this follow-on session on nuances in long-term compensation plans. I also welcome all the Bangalore World Association members for this follow-on session. And we have a lot of demand on this. Like last time we had the discussion 2 weeks back, and we are going to have again the follow-on session on the same topic. And first of all, thank you to Mythili Mr.Arun and Arun Kumar for accepting this session to take our Bangalore World members. Now I request Kusum to introduce the speakers.
Yeah, thank you very much, Subra, for giving me the opportunity to introduce two very well-known speakers and two very well-committed speakers too. It is my proud privilege to introduce Arun Kumar S., who is a partner at Anveshan Business Solutions. He heads the consulting and M&A transaction advisory. He has 27 plus 6 years of experience in various aspects, which includes domestic and international tax advisory, valuations, mergers and acquisitions, business transfers, transaction support services, inbound and outbound investments, due diligences of both Indian and foreign entities. He has handled business structuring. He reviews agreements, contracts from a commercial perspective. He's also well-versed with corporate law matters, and he supports fundraise, both debt and equity. And he's also into estate planning, trust and succession planning. Good morning, Mr. Arun, and welcome to you. And I also, it is my very proud privilege to introduce Mythili Mr.Arun at Anveshan, and she's a part of the consulting division. She has more than 15 years of experience in audit, taxation, and advisory. She began her career at Lovelock and Levis, and she then moved on to accounting support services for overseas hedge funds before transitioning to retail markets. She has now discovered her interest in consulting during the last few years, and she provides holistic solutions to all her clients. It is, it only demonstrates that both of them are so committed to their work and knowledge sharing. This session was conducted, the session relating to ESOP, beyond ESOP, the introduction to various schemes, the regulatory aspects. The session started 2 weeks back, and during that session, we covered various aspects of the ESOP scheme. We spoke about, we understood about different types of long-term compensation scheme. We also, dealt with, the basis that the guidance note provides, and also about the expensing part of it. And today, it is my understanding that the speakers will talk about the accounting aspects. There was a little bit that was left off, so we will be completing the accounting aspects, and we will also be understanding the taxation impact of the various schemes, both in the hands of the employer as well as the employee. And we will also be understanding certain nuances which has come from the experience, the experience that Arun and Mythili have with respect to this long-term compensation. And of course, we will also be understanding the valuation aspects. With this, I hand over the session to Arun and Mythili, and thank you so much for your deep commitment, sir and ma'am.
Thank you so much, Kusum. Vijaya, would you be able to allow screen share for me?
Yes, ma'am.
Yeah, you would love to. Yeah, got it. 1 second, just hold on.
Yes, ma'am.
Okay, so I will thank you so much, Kusum, and I think Arun is also online. He would also be joining on the call. So I will touch upon what we actually discussed last time, just to give a kind of a brief so that it's easy for the transition and carryover. Now, last time we had discussed on are ESOPs the only sort of solutions for long-term compensation plans? Are there any other options which are available beyond ESOPs? We had touched upon phantom stocks as a different kind of an option, ESPP, RSUs, and then we had also touched upon SARs as a possible mechanics. And I had also told you that recently we have actually seen a lot of companies embrace other long-term compensation plans beyond ESOP. Some of them even do it on a blended basis, whereby they actually do ESOP plan as well as SaaS and phantom stock. Because of the inherent issues with regard to ESOP, where you are not able to compensate advisors and other professionals who are also part of the growth story of the company. So we have seen a lot of companies embrace SaaS and phantom stocks as well and float to separate plans. Now, we had touched on key aspects of a general long-term compensation plans, the scheme, and the requirements. With ESOP, we had done a deep dive and tried to understand what are the different regulations with regard to ESOP and what happens in case of vested or unvested options, whether it can be transferable, what does the Companies Act provide in that regard. More or less, the construct for all the other long-term compensation plans works very similar to that of the ESOP. With regard to it considers who are the beneficiaries of the different plans and what would they be able to what happens to the vested options. In those cases, it will be in the form of stock appreciation rights, or it would be in the form of phantom stock units. Similar scenario analysis happens for the different aspects of the scheme with regard to when the liquidity event happens, when a payout happens, what triggers a payout, what happens if the company undergoes an amalgamation or merger or a demerger, what happens to the validity of the scheme, what happens if there is a strategic buyout of the organization. Different aspects is also covered for other schemes. Now, we had stopped at the accounting impact, where we had said that in case of ESOP, the mechanism for recognizing the expense is where we had started, where we say that you do we generally go as per the guidance note in case of an IGAP case, where we say either it can be the intrinsic or the fair value of the options. General recommended mechanism is provided is the intrinsic value, fair value of the options, and we generally avoid different valuation methodologies to arrive at the value. And when we do the expensing of the value of the options for the whole period, we generally see the load of the expense because of graded vesting mechanism. The first year takes a major hit for the value, and subsequently year 2 and year 3, as you see in the slide, it actually comes down to 27, and it is very, very minuscule at the end of third and fourth year. So the major chunk of the expense actually happens. Having said that, we also see a lot of companies, because of ESOP being a big line item and a big adjustment to the, and has a huge impact on the profits of the company, people proceed to working on adjusted EBITDA as well, just to have a tag, because they know that this is kind of a compensation plan that goes, and it is dynamically aligned to the value of the shares of the company. So generally, they also see at adjusted EBITDA. But nevertheless, because there has been a grant and we'll have to do the expensing in a certain manner, we will have to go ahead with the graded vesting. Previously, prior to Guidance Note 2020, we also had an option of doing a straight line vesting if there is only service condition is the main factor. But now in the current Guidance Note 20, post 20, all the grants that's happened subsequent to it, most of the expensing happens in the form of a graded vesting manner. So this I have given. When so a couple of things that also been considered when you actually do the charge off to the P&L is also the attrition that actually happens and inherent as part of that particular industry as well. We have just done a simple scenario where I've just taken options granted to one particular employee, and this can actually move accordingly. Having said that, I would like to touch upon the difference between how equity settled plans work and the cash settled plan works. In case of an equity settled plan, it is generally the fair value of the instrument is what is covered, but the expense is generally credited to the reserves. In case of cash settled plan, the expense is generally carried as a liability account, just like how you make a settlement for any outstanding liability. That's how it is carried. And the difference happens that In ESOP, once you recognize at the time of grant of these options, that is when the recognition happens. And then you don't do a restatement year on year. Subsequent restatement doesn't happen. Whereas in case of cash settle plans in terms of phantom stocks or in terms of SARs, generally this particular liability is remeasured. So for example, if today the value has been 200, then subsequently there has been an increase in the funding value, and the value of the company goes up to 400 rupees per share. At the end of the year, you restate the liability for the cash settle plans. But having said that, it is imperative that guidance note says share-based payments. So anything that is tagged to the value of the shares, it generally recognizes as a expense, and you have to provide for the same. There is no two ways about it. I'll move on to the important aspect for this, because since this is a major hit to the P&L, what happens at the different stages? Loosely put, any life cycle of a long-term compensation plan happens across three different places. One happens at the time of grant, second at the vesting, and third at the time of exercise. When you say grant, the options are identified. You identify the employees who are entitled to these grants, and you provision for so many options is being provided to them. Then after saying that, say for example, for one employee you're given 1,000 options being allotted, you say that you have to stay with the company for the next 3 or 4 years. And if you actually fulfill the condition, then the 1,000 is provided to you in certain installments, which we refer to as tranches. These tranches are referred to as the vesting. So vesting is when out of the 1,000 units that's been granted to him, when it actually accrues to him. The minute it accrues, after that, he can exercise it at any point of time. So generally the accounting for the, and then subsequently post vesting, there is an exercise where the options are converted into shares of the company. Now, the difference between the ESOP and SARs or SARs, which are cash settled, or a phantom stock that are settled, is that instead of the grant and vest would be the same for them as well, but the exercise would vary. There you will not have exercise because it is just a right and you're going to encash it. So with regard to SARs and phantom stocks, which are cash settled, you generally have, and instead of an exercise, you have what is called as a payout event, where the money which is carried in the liability is actually paid out in cash. In case of ESOP alone, it converts into an exercise where the liability that is sitting there converts into equity. Now,
can I just interrupt for a moment? I just have a
yes.
Query relating to the scheme itself. I mean, not exactly the scheme. So can there be let us say there is a scheme that is called ESOP 2023 scheme. Okay.
Yes.
Now in that scheme they would have actually set aside some stocks, and they will use that for identifying employees and granting based on whatever is the parameters. Now, the ESOP scheme, whether they can use the same scheme for granting, stocks to employees even in 2024, 2025, 2026, or every year when they actually do a fresh grant, whether there should be a new scheme?
So what we generally see is that once you initially create a pool, because you provide for current dilution and then future employees who are going to join as part of the company, the dilution for them as well. So you don't do it in just-in-time basis that today if I'm going to grant 50 units, I create a scheme only for the 50 units. We generally create a kitty saying that when we generally do a cap table, we say a 15%, which will be the pool created. This pool itself gets floated as an ESOP scheme. So till that pool is completely extinguished, the scheme continues. Then whenever there is an add-on to a pool or the pool is expanded, sometimes they do it as an amendment to the existing itself. If the pool is completely exhausted, then if they want to add a new set of kitty, then we see people actually go ahead with a new scheme and float a separate scheme for that.
So only when it gets exhausted, what if they decide
Yeah.
not to kind of pursue that particular scheme and they want to amend it? Is there a possibility and there is still some pool left that is left which is unutilized? How do they deal?
Then whenever there is a pool left, they generally grant it as part of that. The only time they actually look for a new scheme is whether when the pool is completely exhausted, or if there are any major variations in terms of any particular rights or any particular excise price or something specific that gets granted, then they float a new scheme. Usually
the stocks that are not granted yet, they get extinguished or they get migrated to the new scheme.
So what happens is the stocks that are not granted, it still lies in the pool and is eligible for grant under that particular scheme. So they usually use the scheme till the entire stock is actually exhausted and everything is granted to people.
But just in case they decide to abolish that particular scheme, what do they do with the ungranted?
So once you say the scheme is scrapped, then
yes.
it is like the whole thing is cancelled.
Correct.
Then you float a new scheme altogether. You don't need to repurpose the scheme.
No need to repurpose the scheme.
No. Generally, we prefer, see, from a diligence perspective, we try to avoid repurposing scheme. We keep it clean and say, today the intent was to increase it by so much, and this is the pool that we created. And that till that pool is actually exhausted, we use that existing scheme itself. It is only post that particular grant, all the grants have been provided under that particular scheme, then we move to a new scheme.
Okay.
Till then, that particular scheme is used in entirety, unless there has been a major acquisition of the company and they say that let's settle this particular employees, or they say that we want to float our own new scheme and they want to scrap it. That is the only time they generally do it.
Okay, so but it is a possibility that it can actually be scrapped and a new scheme can be
started,
it can happen. And only those things will be settled to the extent that has been granted. Only those things will get settled.
Yes.
Granted, and as long as other conditions relating to vested exercise are satisfied.
Correct. Yes.
And there could be accelerated vesting also at certain times.
Yes, certainly. That is up to the management. That's why they say that if there is an acquisition or any buyout that happens, then you give the drag and tag along. So you have to accelerate the vesting so that they also enjoy the part of the growth.
Sure. Thank you so much.
Okay, perfect. So I will reiterate here with regard to the accounting side. So the accounting happens at the time of grant. The mechanism of expensing is based on vesting, and the actual conversion to equity happens on excise. Now, at the grant, the recognition is actually done. Then how do you recognize the expense is based on the vesting schedule, where you say that at the end of 1 year, 2 year, 3 year. So the question comes up, the provision for the ESOP pool happens at the time of grant. The recognition happens at the year end, where we say that this so many options has been granted and so much has actually due for vesting, and we expense out based on the period of vesting. Now, in case of cash settled, as I said previously, it is carried as an expense. Now, the point to note is that in case of the employer, how the tax liability tax deduction happens is that ESOP is not specifically covered under any of the provisions of the Income Tax Act. There is no specific call out under any provisions of the Act with regard to ESOP. Hence, it classifies under the general category of Section 37, where if it fulfills those requirements, then the expense is allowed as a claim. Now, the point to differentiation to be noted here is that even though you recognize it as an expense in your books, the TDS provisions are not triggered at the time of accounting. The TDS provisions with regard to the expense is triggered only at the time of excise, when they convert it into equity. Till then, the TDS is not triggered at all. In case of between the ESOP and the cash settle scheme, the point of distinction happens in the terms of how it can be treated. Now, cash settle scheme, because these are they have a kind of a color to a bonus, and it is more like a structured bonus plan. There is a possibility that these could be treated as at par with bonus, and Section 43B of the IT Act can be allowed. Now, when I say 43B, it means that bonus is generally allowed only at the time of payment of the money or settlement of the amount rather than at the time of expensing. But with regard to ESOP, it is taken as an unascertained liability because how much is exact liability is not determined, but it is not contingent in nature as compared to how a cash settle plan works. So between the two, this is the small point of distinction that happens. In case of cash settle scheme, again, the payout on the TDS generally happens at the time of actual payout, because there can be said that it can be argued that this can be a contingent liability. Now, I'll delve a little deep into the ESOP part on allowability in the hands. As per section 37, what can be allowed as an expense generally is what is not claimed from section 30 to 36 of the Act. It should not be personal and expenditure, nor should it be a capital expenditure. And it should be an expense relating to the previous year. And it has to be for the purpose of the business or profession. So based of it, hence, if you fulfill the above condition, then you have an eligibility for claiming it as a deduction under section 37. Now, that is one of the basic premise under which how ESOP is generally considered as an expense. But this being said, it is generally a very litigative stand, and people have generally fought it out and then allowed it as an expense because this is some place which revenue really loves to dwell on. And we have a lot of Bangalore ITAT in our favor as well, which supports claiming as an expense in the books. Now, the recent one which we had was the Flipkart one, which has allowed it as an expense in the year of vesting itself. Now, one of the major case laws that we have with regard to this happens to be the Biocon case law, which actually provided a major, it was a trendsetter rather, and most of the subsequent case laws have strongly referred to the Biocon case law with regard to allowability of ESOP as an expenses. Now, it said that the main driving point of Biocon was that it said that even though it is actually not an expenditure, even loss can be categorized as an expenditure and is allowed to be claimed. Hence, they said that any amount between which is the offer price and that grant price, both of the differential can be treated as remuneration for the continuation of the employees and can be allowed as an expense. Now, one important thing that we had observed when we actually did an analysis with regard to ESOP allowability was also in the case of Roto case, where they said that warranty provisions which have been done for products sold, even that is allowed to be claimed as an expenditure. Hence, there is when even warranty is a provisioning item, it is exactly cannot be ascertained in perfection as to what it is. But the fact remains that there remains a liability. If that has been the premise with regard to even warranty claims, we can take the same basis for ESOP, and you can claim that as there is enough merit for claiming ESOP expense as a deductible expense. So this was one of the strong cases that has been claimed. Of course, Flipkart is one of the recent ones that was taken, and that also strongly referred to the Biocon case as well with regard to claimability of ESOP. Now, as I mentioned, with regard to cash settled plans, the main point of differentiation between an equity settled and a cash settled happens to be because if it is in the nature of contingent liability, then it may not be allowable as an expense under section 37. So it might get into a 43B classification. Then you allow it only at the time of actual payment of it. And TDS provision gets triggered at the time of settlement of the expense. This is with regard to the employer side. Now, I come into the employee side. Now, employee side, at the time of grant, there is no trigger event. At the time of vesting, you have only right with regard to the options. Then again, there is no trigger. But at the time of exercise, that becomes an automatic trigger where you need to value the FMV of the particular stock that's been allotted to the particular employee. You get a merchant banker valuation justifying the price, and the same is added as perquisite for the employee and is taxed along with his salary. When once the shares are allotted, based on perquisite, he has a cost to him, and the shares are allotted in his favor. The subsequent trigger for taxation happens when the shares that have been allotted to him get subsequently sold. and that gets sold, taxed as capital gain. And this happens when the person sells the shares subsequently post the excise event.
So can we actually conclude that whatever is the fair market value can be considered as an expense in the hands of the employer, and that same fair market value will be the cost basis in the hands of the employee?
So what we discussed last time, I'm reiterating it. So what happens is that what is fair market value ascertainment at the end during exercise is a separate event, and that takes care of only taxability in the hands of the employee. The accounting standard requirement of ascertaining liability happens at this time, which is the start, which is the grant of the options. Now, this squaring up in the books between the FMV as on the date of excise and what is in the grant doesn't happen. The guidance note doesn't provide for that. Hence, there is no possibility for doing that squaring up between the actual excise event and the time of grant. So that doesn't go through the P&L. And that gets only added in the hands of the employees as perquisite taxation. This just happens to be an anomaly, and I've had discussion with multiple professionals on this, but this is an anomaly that stays as part of the law.
Madam, can I have one doubt?
Yes, sir.
Well, last time also we discussed, assuming that when the ESOP is granted, FMV is just 30 rupees. When it is vested on 5th year, FMV is maybe say 500 rupees, just for discussion. Company will charge off difference between 30 and minus 10 as a 20 rupees over a period of 5 years.
Correct.
Whereas on the date of excise, employee has to pay the tax on the 500 rupees.
Correct.
500 minus 10.
Yes. Yes.
Sure. Sure. Thank you.
Now, I just wanted to touch upon a couple of items. Some of it is litigated, there is no direct interpretation under the law, but there are a few things that I thought will help in terms of structuring and have a better understanding. The first case, what I had said was the sale of the ESOP shares, which is a very straightforward. Employee exercises, the shares are allotted in his favor, and subsequently the shares are being sold to any third party, which will be a secondary transfer. And then that is basically a share transfer, and it is taxed in his hands as capital gain. The period of holding for this, unfortunately, starts ticking only from the time he is allotted the shares and not at the time of he is granted the option. But there can be other multiple ways in which also they do a couple of structuring. Now, the other alternative that they do is through the mechanism of a buyback, and where the company acquires the shares. This is more in case of, in certain cases where they want to remove the employee off a cap table and they want to initiate a buyback. And buyback, of course, is subject to the company law provision where, you have a certain threshold up to which you can do a buyback and not beyond that. But in this case of a buyback, it gets taxation gets triggered in the hands of the company. With regard to the employee, he doesn't have further taxes, and it will be exempt in the hands of the employee. Another alternative that we have seen is cash in lieu of the options, where options are not exercised, but the options are surrendered. And in lieu of this, there is a money payout to the employee. Now, there has been a lot of lot of case laws which has even said that since it is an option can also be treated as a capital asset, and it can be claimed as a capital gain. And there has been some structuring that we have also done on those lines, whereby we have provided and worked it as a capital asset, and we have provided benefit to the employees. But this is also highly litigative. We'll have to go through and fight it out in order to do it. I can also share the couple of case laws that we had with regard to SARS. We can also do it in case of SARS and other this thing. We have a lot of precedents, but this is also a litigative. This is not a very clean route, but it is also a litigative route. So this is one other alternative options that has been adopted in the recent past. So the plain vanilla model of taxation for the employees I had covered. where its exercise and subsequent sale of the share is subject to capital gain. Now, in case if it is a startup, there is a certain benefit that has been provided. Some of this I want to re-emphasize here because as part of practice, we come across where they say that if I am a DIPP registered startup, then a lot of there has been a presumption that the benefit of deferment of tax to an employee is very automatic. Please note that it is not automatic. Startup is just a first step that you provide there, where you get a DIPP registration. But after that, you need to go and register through the ATIAC route, where you have a new one, which is an eligible startup, which is a carve out and income tax creates. And only when you are an eligible startup and you are eligible startup under ATIAC, where you have a eligibility certificate from an interministerial board, only at that point does the benefit of deferment of a taxation to the employee happens under this. Otherwise, it is, even though you are a DIPP, the employee is treated with the general crowd, and this deferment doesn't happen. So from an employee perspective, it is important to ask whether the startup that they are working is an eligible startup and they have this particular recognition. Only then the deferment actually happens. If it is so, then you can postpone the liability to the date of either sale or you say or cessation of employment with that company, or 5 years from the end when the security has been exercised. This is a benefit that is being provided. But here it has to be to a carved out group, which is the eligible startup group, and not to all startups. Now,
can we just spend a couple of more minutes on this slide? So when we say 5 years from the end of the year in which security was exercised, again,
yes,
the only thing that is happening is whatever is the perquisite payment has only got deferred.
correct.
But in case of, in the first instance, it is, assuming that the employee has not sold and he only, he has exercised, let us say he is an employee of an eligible startup. He has been granted and, these options, which he has also exercised. And in the year in which he has exercised, he has not paid the taxes. But fifth year from the end of the year in which he exercised the security, he is still going to pay taxes only what he was supposed to pay in the year in which he was otherwise supposed to pay the perk tax.
Yes, yes.
Yeah, but so assuming he has actually sold that sold it in that particular the stock in the same year that he pays the perquisite tax, that is 5 years from the end of the year.
Then it automatically, whenever he sold the security, that would be the point of automatic trigger of perquisite there.
Yeah. I mean, I assume the point that I wanted to make it, he will still be able to get that, benefit of long term, right? Even though he has paid the perquisite tax in the fifth year, he has actually exercised it.
Exercised. That should be, yes, that should be eligible, because that is the point of conversion. The shares gets allotted to his name.
Shares get allotted to him in the year in which he exercises. He has deferred the payment of perquisite tax, and assuming he sells, and at the end of fifth year, he's supposed to pay the perquisite tax in his, which will get reflected in his Form 16, and he will also be paying capital gains tax, and in this case, it will be a long-term capital gains tax.
Yes, because the shares gets allotted in his name. Yes.
Yeah. And we also have to understand that, there will be in most cases, these eligible startups may be privately held and not really listed. So therefore, one has to be aware of the long-term capital gains tax rate.
Yes.
That they have to be aware of.
Yes, correct.
Yes, thank you so much.
Right. Just 1 second. So moving forward, this is with regard to the cash settle scheme, where I had mentioned previously that though they might not be allowable under Section 37, but there is a possibility that they can also be treated similar to that of the bonus, and hence they will be treated at par with bonus, and they will be allowed at the time of payment. The one thing that is to be noted is that even redemption of in case where SARs are actually provided to any advisors, there might be a GST part. I'm not too expert in GST here, but I just wanted to park that thought with you, because what would be critical would be the timing of the service, whether the service has been rendered or whether it's the actual receipt of service. There have been a lot of people who take up the view that it is the trigger for GST also happens at the time of provision of the service. Hence, they say that GST is to be done only when the money actually comes. Otherwise, it is a contingent liability and there is no visibility that the service is actually provided, because the whole service is, even though it is provided, it is tagged to the value of the stock option. Hence, there are people who have different views with regard to that. But this is something that you have to be cognizant of when you deal with payment to an advisor.
I would like to share my experience here. In this case, there was an instance where services was actually received from a foreign national by an Indian company. Of course, it is not it was definitely a startup, but not an eligible startup. So the position that we took was, the consideration was actually defined, as to whatever was the consideration was defined in terms of what they will be eligible with respect to the stocks. So we did a valuation, and since it was actually the services were received from a foreign national, the company discharged the GST liability under reverse charge mechanism. So I think it is, it is important, because in GST, there is something called time of supply provisions also. Correct. And GST has to be discharged as and when the services are rendered, and not necessarily when the consideration is received by the recipient. In this case, it may be the advisor or the consultant.
Correct. So if the contract is very obvious as to what you're going to deliver as part of it, just because the consideration is deferred to a certain date, it can't be said that there is no supply. Hence, there could be a trigger event there. So this is where I said, in case it seems very easy for an advisors to provide them SARs, but it's very important to also how you word the agreement and how you can, so that there is no trigger for GST in this regard. I will delve a little into the different case scenarios that we come across. This is more out of practical side that we have seen in terms of implementation of these long-term compensation plans. So I thought I will dwell on a couple of case scenarios and see how it actually impacts the different way forward that we have seen. A very common scenario that we have seen is case of transfer of shares from promoters to any co-founders who happen to be existing employees. Now, in this regard, there has always been where the shares are being transferred to the co-founder. They sometimes undertake the transfer of shares at face value. Now, this transfer, whether it would have a trigger under income tax, is something that we need to keep in mind. First of all, whether if the co-founder also happens to be an employee, whether there is any likely exposure to perquisite under 17(2) is something that we need to dwell on. What is important to note, or a perception that we generally have, is that it may not be a direct trigger, but can it be an indirect trigger is to be noted. Generally, in this, our contention has been that if there is since there is an agreement that happens only between the promoter and the co-founder, and there is no company is involved, and company is not part of the whole mechanism, and we try to keep the completely out of it, and it is just an agreement between two independent parties, then we try to avoid the mechanism, and 17(2) trigger as a result of this kind of transfer. But one other thing I always insist generally to the companies when these kind of transactions happen is to have a quick check on the value of shares as per 11 UA. Now, 11 UA is like a silent monster that is sitting, and we don't know when it gets triggered and what is the value. And sometimes the issue happens also because what is the considering what will be the formula that will be considered under 11 UA. The general impression is that 11 UA is only a book value, and most of the cases the book value of startups is negative. Hence, the value is will be zero. But it is also to be noted as to what will be the value of 11 UA when you go strictly by the formula. When you go strictly by the formula, the wordings of the rule is such a manner that even if you have premium for preference shares, it gets loaded as part of equity shares, and it doesn't give you any mechanism for ascertaining the value on fully diluted basis. Hence, that is something that needs to be kept in mind. And we have seen on practical side, even recently we had a certain case where we had determined the value based on the 11 UA, and the value was completely skewed in favor of equity shares, and all because of the share premium from the CCPS. But the client took another view, and we had the merchant banker and as well as one of the big fours trying to give a value which is on fully diluted basis, and they were completely in line with that. So they took that particular route where they calculated the FMV on a diluted basis. But there is a certain inherent risk when you do this. So generally, if there is a transaction value as per 11 UA, it is better to go with the value as per 11 UA than resort to value at face value per share. That has been the general thought process, because even if it is in the hands of the recipient, there is a trigger under 56.210 where they say that if you are receiving a value for an inadequate consideration, and the way the inadequate consideration is determined is the consideration that you actually pay as against the FMV of the particular share. And the FMV as per 11 UA, if it is a higher amount, then there is an automatic tax trigger there. And this needs to be considered as an alternative. We need to, generally when such kind of transfers happens, please don't do a thumb rule where say you make the transfer at the face value. Please have a check as to what is the 11 UA value. Have a look at it and see if there is a trigger, and address the trigger before you make the transfer at face value. So this is something that I wanted to indicate. In fact, you need to be more careful if the transfer is from the promoter or employee who's residing overseas. That is another issue, because you will have issues of pricing guidelines that gets applicable based on FDI. So that also needs to be kept in mind. Hence, it's very important. A couple of first things, the questions that we need to ask is the transfer between two parties who are first residents. You rule it out, and then secondly, if they are residents, then check whether if there is a trigger under Rule 11 UA. If it is not, then go ahead with the transfer at face value. Otherwise, this will have to tread it with caution. This is one. Then this is another scenario that we generally see where most of the cases are triggered where person has joined as an employee and subsequently he comes elevated to the level of a co-founder, and they want to give a portion stake from their thing. They want to give a carve out. If it is a carve out, then as I said, when a secondary transfer happens, then if it is not a carve out from the existing promoters, then it is in the form of an issue of shares. Now, when you say issue of shares to a new employee, then we need to be very careful whether there is a trigger under 17.2. 17.2 is the biggest trigger here. Whether because it is shared as even though you might make an issue of shares in the form of rights, whether there is an employee connection there, and whether can it be deemed to be 17.2 trigger happens is something that you need to be very, very careful about. If it is not an employee, then you don't have a specific agreement. Then in that case, we again need to do value, see whether the value is as per 11 UA, if there is any possible exposure there. then you do a rights issue or anything. So because if it is a rights issue and there is a 11 UA value which is higher, then if you're doing the rights issue as 10, under Companies Act, you still be allowed to do it. But under taxation, both in the hands of the recipient as well as in case of mainly in the hands of the recipient, there will be a trigger under 56(2)(10). So that is one possible exposure that might happen. We have seen a lot of cases where they kind of do this kind of allotment. We always say that reading on a holistic under both laws is very, very important, and see if there are any triggers. Otherwise, trying to fix the problem after 2 years on scrutiny is a real headache. So these are a couple of things that we keep in mind before we go ahead with such kind of issue. And the trigger is more in this scenario as compared to the previous scenario, because here we also have the company as part of the this thing who is actually issuing the shares. Then in that case, there might be a straight trigger under 17(2), and the risk is very high. I would like to touch upon one more aspect with regard to ESOPs. Now, with people going through the externalization mechanism, we see a lot of trigger in terms of cross-border ESOPs coming in. And I would like to also reiterate one point here. It need not be only cross-border ESOPs. We can also be cross-border SARS or a phantom stock. But ESOPs are the ones which are regulated, because these you have shares being allotted pursuant to the transaction for employees of the subsidiary company or the holding company. Now, when the shares are actually issued, where the parent issues to the employees of an Indian subsidiary, then this comes under the ODI scenario, where the employees are all sitting out in the subsidiary here, and the shares are being given from the holding company. Now, under the ODI guidelines, who can be provided shares has been specifically listed out, and it allows any office in India, as long as the person is an employee and of a subsidiary, there is an association of employment with the subsidiary, and it provides for mechanism for providing cross-border ESOPs. Now, there is one pain point with regard to this is that the reporting requirement under the overseas rules. Now, any contribution that's made by the employee towards this particular ESOP subscription to it comes under the LRS, and it cannot go above the 250,000 limit that has been provided. Whereas, but the reporting headache for the same onus is on the employer. So even if it is an employee who has left the company will have to be very careful and make the reporting for the same. And this is an absolute headache and a nightmare with regard to reporting requirements. But nevertheless, this has been the requirement on law. And it's important for the company to make a semi-annual reporting for this with regard to these ESOPs that has been provided. So this is one other. And from the company side, they have to be very meticulous in terms of taking out what are the PANs of the employees, because each of them case it would get a trigger, and each person's PAN, the LRS requirement and TCS requirement also gets triggered in these cases.
But TCS will actually be done by the bank whenever the employee initiates the payout, right? So
Correct.
that is. But the only reporting, well, the TCS requirement is, handled by the bank. The reporting requirement has to be done by the employer, even though whether or not the, the
current
employee
or he has left, right? The headache of reporting stays with the employer.
And what will be the control? It will be the details. I mean, who will actually be giving?
This is one thing that all the employers actually ask us. They ask us, how do we keep track of this record? Then I say that it is very important you stay in touch with the other employer to, the trigger point happens at the parent. because if somebody is trying to exercise, then the trigger point happens at the parent side. So we always say that please have a very close association with your parent. Most of the cases it happens through the company, but we always say we also have a very strong line with your parent, so that you
They will give the
privy
data
to
dump as to the list of the employees
list
who
of
have
employees.
actually purchased the shares. And necessarily it has to
Exactly.
be purchased. No, when and details should be made available. Yeah, sure.
Yes, so we tell them, please kindly keep your parent company informed of it, and tell them you have a reporting headache, and please cooperate for this. Otherwise, this becomes another nightmare. So,
No, but in that case, only we need not be in touch with the employee, right? It is just that we can actually just if the parent gives the details of the names of the person, other details might possibly be with the employer himself, like the PAN and other information.
Correct. So we generally say that you have it. If,
and all
the two-sided information flow, ensure that everything is crossed and checked. So we generally ask them to have, but more with the parent, because they will be the first person who will receive the information with regard to if there has been an excise and all that.
But just another dimension, what in case that the employee has actually left the country and he's left the job, left the country, and he is no longer a resident in India. In that case also, is there a requirement?
So the requirements of the regulation says only with regard to reporting requirements. So reporting you will have to anyway require. Other aspect which regard to LRS will not get triggered if the person is overseas.
Yeah. So is my understanding correct that only in case of the LRS scheme only needs to be reported, or anything other than the LRS?
No, it says reporting for anybody who has been provided under the ESOP. So if the person has left the entity and he's been an employee as well, you still have to report it. But the subscription will not happen.
The employee's residential status.
Yes.
So we don't have to be worried about the employee's residential status. We just need to actually only report what are the options that have been granted or purchased.
Yes.
In this case.
Okay. Correct.
Yeah, Mythili. What would be the tax implication in the for this transaction in the foreign country? So would there also the withholding tax triggers?
So if the withholding tax trigger is mainly from a Indian point of view, because they are employees in your books, and if there is a requirement under the law for you to do it under 182, that trigger happens here. So generally, the norm is that as part of the scheme itself, this is generally written that unless the withholding tax is paid under the regulations that are being applicable, no shares will be allotted. So that is generally as part of scheme itself, they keep it, and as part of the agreement that they execute with the employee, they have it saying that you have to remit the money or do something where you discharge the tax liability, so that it doesn't come back and sit on our heads. And hence,
Mr. Sagar's question was whether there is going to be any withholding tax implication at the foreign entity level.
Foreign entity, no. Foreign entity it will not. But since they have to release the shares and allot it in the name of the employee here, the local withholding tax requirements gets triggered.
No, but if they are going to book this as an expense in their books, so I don't think so their foreign regulation will allow this transaction to be done without the withholding tax.
Correct. So what happens is generally we have it in the form of only a TP transfer. So this would generally go through as expense in the books of subsidiary, and then it is cross-charged across to the overseas parent, and that is a separate trigger. So in our
experience, we see that it does not impact the employee as such. So there is no withholding whenever stocks are allotted to the employee by the foreign entity. But one thing that may be worthwhile to notice, when the employee becomes the owner of stock options, he is entitled to all the privileges that comes along with the stock options. For example, if there is a dividend that is declared, then he is entitled to the dividend. And as per my experience states that there will always be a dividend withholding tax. So there will be in respect of the dividends that are declared by the foreign entity, withholding tax will happen at the source itself, which is where the foreign company will actually withhold the tax and then release the balance of the amount in the hands of the employee. And of course, talking about the taxes, it is the obligation of the employee to report the dividend income and calculate the Indian tax that is applicable, and also claim credit for the tax that has been withheld at source. This is in case of the dividend income.
Okay.
Actually, we in this case of this ODI case, we have two sort of documents. Though most of the cases that we see, there has been a trigger and expensing that has happened in India. You generally have a cross charge which happens across. So, have anybody seen where there is no cross charge for these ESOP expenses? Because that would be a trigger for TP as well, right? In case there is something here and that has not been cross-charged across to overseas.
So considering that it will form part of the expense, and usually there will be work on a cost plus basis, would it actually be automatically charged?
Yes, that's what we saw. Because though guidance note talks about you carrying it as an as the parent is giving the shares and there is no liability on you. We see the guidance note provide for that. But generally from TP part of regulations, we always see it come out as a cross charge. So even though it is taken as an expense here, we see it cross charged as a reimbursement from the parent entity. Though of course there is no equity that has been allotted from the subsidiary itself. So you generally have an investment adjustment for the parent that is there in the books. But generally it goes through, but I've never seen one where there is no cross charge and directly goes through the balance sheet as investment. So that's why I asked.
So you mean to say directly their parent is contributing to a capital. So like that.
Yes.
Okay. So basically even in APA, whenever the advanced pricing arrangement they're doing, so that they're also suggesting that you cross charge.
Cross charge, correct.
Nowhere it is exempt, except in one of the case where very small portion it has come as a capital contribution, but nowhere we are exempt in that cases, cross charge cases. So ideally, even from a TP angle, they're cross charging.
Cross charging, right? Okay.
No capital contribution, it will come. Sometimes they will feel that any specific to a particular project, if they want to contribute as a capital contribution, they can bring that one, but not as a cross charge.
Not okay.
So if any specific to a particular project where the subsidiary is doing, so then parent wants to invest that one, so then they will not show it as expenses, but again it is a TP litigation.
It's a TP litigation, exactly.
Then it will be like a capital contribution by the parent entity and as a part of other equity. But indirectly it will go to other equity, but it is not
other equity,
through,
right?
Yeah.
So it carries as, I think, equity, and then again in the parents' books, it will be capital contribution and then investment and subsidiary. So the subsidiary and equity gets, other equity, it gets cancelled out with investment and subsidiary for consolidation.
Yeah, correct.
So this is the flip part of it where FTI gets triggered, where the Indian entity is providing shares to the overseas employees as well. Hence, a similar kind of trigger will happen with regard to how we had done for the ODI, and the reporting also has to be furnished under the FTI regulations. Now, the eligible person is again employees and directors, and this is general form with regard to ODI and FTA. So this is something that's seen. This also we don't see a lot of advisors, though in overseas entity we see a lot of requirement for advisors also being given as part of the option scheme. But Generally, we don't recommend, because our ESOP structure under the Companies Act is very, very not very. It doesn't provide you so much leeway for providing shares to advisors. Hence, generally, it is not a recommended form for advisors. But overseas entities, we see that where they also provided for advisors directly the scheme. We generally tell that is outside books, please, but you please go check on a GST trigger. This is generally off the line. I am discussing, I'm not specific slide on it, but we say that generally see a trigger for GST for that particular person who's a consultant and who's been provided overseas equity. So that is something that comes into the GST kitty. So this is what I was mentioning with regard to the cross-charge part. Under transfer pricing, ESOP is also considered as part of remuneration and would require cross-charge across to the overseas entity. So this is what I had mentioned. I will...
Mythili, so related to cross-charge, what I understand is that if the overseas company is issuing the ESOP to our employees, then if the face value is 10 rupees, that is the exercise price, and the fair value is, for example, 500 rupees, then are we saying that the transaction between the parent and the subsidiary would be at the 500 rupees, which the Indian company has to pay to the overseas company?
No. So it would be based on the valuation that you undertake on that day. So even if the exercise price is higher, what is it that you are actually, as on that day, what would be the FMV trigger? That would be
So exercise price is 10 rupees and the fair market value is 500 rupees.
So FMV, if you do an option valuation today, and if it's 500 minus 10 would go through the cross-charge route.
So Indian company has to pay that amount to the overseas entity.
It doesn't pay. It is basically carrying it as an expense here, right?
No, carrying it as an expense, but ultimately I will have to pay some. If there is a cross charge that the foreign company, what would be the transaction between the parent and the subsidiary, and at what amount?
So with regard to the subsidiary, the expensing would happen at between that 500 and 10, which will be the value that you, assuming that today is the value for that. The final trigger on exercise happens in the hands of the employees itself as part of perquisite. But you need to do...
Just to step in, the cross charge can be 490 rupees. That is 500 minus 10. When the cross charge happens, I'm looking at two ways. Either I can add it to the capital as capital infusion by the parent to the Indian subsidiary. That is one. Or Indian subsidiary has to make good for that 490 rupees. So 490 rupees has to be paid by subsidiary to parent.
So in the first option also, the parent has to infuse 490 rupees into the Indian company, which will go to the parent again by way of the cross charge.
Correct. And then because of this cost plus or any other mechanism that subsidiary adopts for the billing, for its revenue billing, that gets marked up, and then again it gets invoiced to the parent.
So what I mean to understand is that in this kind of transaction, generally what the ESOP generally tend to be is that there is no cash expense to the company, but here there is a cash movement of the company also required if there is a this kind of arrangement is there. Because here the cash movement is also required to be made between the parent and the subsidiary to make good this to complete this transaction.
Correct. You are absolutely right.
Okay.
Otherwise, see, when I debit to the P&L, where is that credit going? It has to go as a liability, right? So that is where either it gets in, it gets showed as a capital. Then there is no cash movement. It just gets added to the capital, share capital, or the if there is a liability route, then it gets paid out.
So here the cash movement is required.
Yes.
Madam, on the same lines, I have one more doubt.
Yep.
But you said in my previous doubt also, you said if the FMV is 30 rupees and on the excise price is 30 rupees and fair market value on the third year is 500 rupees, you said only 30 minus 10 only has to go for amortization. But now, if the company is under Ind AS, but normally they need to, their accounts has to show on a fair value basis, whether they need to take this valuation every year, madam?
No. So as I said, when you take the valuation for this, you do the valuation of an option at the time of grant. Subsequent FMV valuation, you don't take it at all. The only other time you take the FMV valuation is at the time of final exercise.
That is
When
for
it
employee
is
purpose. That
that
is
is
for
for employee purpose. That doesn't get flow into your employer purpose. Only for the limited purpose of perquisite liability and tax withholding, you use it.
Ma'am,
Otherwise, you don't use it for accounting in the books.
No, there are two issues now. When on the date of excise, the FM is 500 rupees, in the initial value was say 30 rupees, extreme situation, where company is expensing only 20 rupees over a period of ESOP period, and employee has to pay the tax, point number one. Point number two, when the company allows a share, they'll book a share payment of only 20 rupees instead of 480 rupees. I don't know, just again I'm asking this.
Yeah,
repeated.
I know. I understand where it is, but this is what the standard says. There is no square up between that 500 and that 30 at any point of time. In the books of the company, you don't do that square up.
Only for employee purpose.
Only for employee purpose, it is like considered as two separate events. One in the hands of the employee where it gets taxed, another in the hands of the employer where you make a provision and do it. And employer for the limited purpose of TDS withholding alone, you pick up the FMV for which has been taken for the employees.
Even for TDS purpose, you was considered how much? 500 rupees.
You will have to consider because the TDS trigger is from the employee side.
Okay, got it.
Irrespective of the income side. So you have absolutely no what do you call control over saying that this is what I have booked.
Okay, thank you.
So I will just elaborate a little on this trust route, which we have seen a lot of companies actually employ. In case where they actually want to carve out a certain portion of their cap table into as part of ESOP trust. Now, ESOP trust works fabulously in case of what do you call limited liability entities where the ESOP trust creates the kitty is allotted and this has been provided. The ESOP trust generally the employees buy the shares from the ESOP trust and then you go sell it in the market. So this particular setup generally happens well in case of listed entity. Some of them we see have adopted ESOP trust as part of unlisted entity. And there is quite a bit of a tax headache when it comes to ESOP trust for unlisted entities. For example, we had this whole concept of 56.2 or 50 CA that came up, which was for unquoted equity shares. Now, unquoted equity shares under 50 CA, because it was a separate provision and it was a deeming provision for FMB. Any transfer by the promoter to the trust, if he happens to do at what do you call just the face value in order to give away the shares for using for employees, then the impact of 50 CA is something that you need to verify, and also 56 to 10, because all said and done, though the trust is for the benefit of the employees and everything, it is considered as a separate entity. And this particular transaction is not specifically exempted under the Act. Hence, the same will have to be considered for the purpose of taxation under 50 CA. Now, what happens is that if there is a value acquisition that happens at at the trust level, then you will have to see what is the value of the shares as per 11 UA. You will have to run a check on the 11 UA. And since if the trust is not providing any consideration, then you will have to, because it is acquiring the shares at a favorable value, you will have to offer it for tax in the hands of the trust on a deeming basis. So even this trigger is also there in the case of issue of shares to the trust. Similar to what I had mentioned previously, if you make a simple allotment of shares at ₹10, because these are part of this unquoted securities, it is very important that you have the trigger for what is the value that you allot it for. If you do it at 10 rupee for a very standard value, and there is a 11 UA trigger which is for a higher value, then there is an automatic 56-10 trigger which will be in the hand of the trust. So this is something that needs to be kept in mind with regard to trust, where trust is in place. And also when the company, when the employee actually pays the consideration to the trust, and the trust is actually transferring the shares, then that is the when the trust has to make the payment, the implication for 50 CA also to be seen. But generally in this case, the trigger is lesser because the FMV for the employees is generally what has been, if it is aligned to the the value of the shares, the FMV of the shares, then it is not problem. If the excise price that is to be paid by the employee is like 10 rupees, then we need to be very, very careful, because the trust will be receiving only 10 rupees as consideration, as against what would be the possible FMV value. So this is some trigger which needs to be kept in mind. We generally, as a thumb rule, say that in case of unlisted entity, if you're going through a trust route, be cognizant of the fact that there is an likely chance of trigger for taxation, and weigh the pros and cons before going and implementing a trust route in case of private limited companies. So this is something that we thought we generally advise people not to do this headache because of this taxation problem in the whole thing. So if it's easier to implement in case of a listed entity, but in case of an unlisted entity, it's quite a bit of a problem. So we have multiple queries.
Yeah,
yes.
Mythili, you beautifully explained, but can we just enhance this understanding through with the help of say numerical examples? Let's start with an unlisted entity creating a trust, and it has actually, there is a pool of shares that are being transferred, and and let us say when the pool is transferred, if you can just elaborate with some numerical examples, maybe our understanding will get better.
Okay, so we had one particular case where we had done, the promoter had to give up a number of shares to a particular trust. He had to make a sale for the trust. So what the company decided, that instead of actually buying out or through a buyback process, they said, why don't we park this particular promoter holding as part of the trust shares? So they had actually made a transfer of shares, say 1,000 shares that was being held by the promoter. They gave the exit to the particular promoter through the trust, where the trust was actually buying back the shares. Now, say the for 100 shares that is being provided exit by the promoter, the trust was buying the shares at a certain value. So it was, say 100 into 500 rupees was the exit that they were providing to the promoter. Now, I'll see if I can put a quick Excel for that. It will be much easier.
Yeah, I just wanted to understand, how will the trust get funded?
The trust will get funded only by the company.
So with cash?
Yes. And it will be an advance that has been provided by the company to the trust. And the trust will, that money will stay as advance for the trust forever. There is no squaring up of the accounts, because the trust will not have money to pay back. The only stream of funding for the trust happens to be from the company. So it gets carried, and
it's only
it's always one-way basis. Yes. It's a one-way basis.
So whereas it will appear as an asset in the company's books of account, it will appear as a liability in the trust's books of account.
Yes. Yes. And it stays forever, so because it never gets squared.
The company has actually funded the trust?
Yes. The company just funds the trust.
The company has actually funded the trust using that that money that the trust has actually settled the promoter in your example.
Yes, correct. Because there is no other mechanism by which the trust can get money. There is no way it can go raise money. So the only source of funding for the trust will happen only from the company's point of view. One second, let me just see if I
so
can.
going back to your example, so let us say 500 into 100 is what, there is one lump sum money that has been contributed by the company to the trust, and the company has utilized a portion of it and it has settled the promoter, and now it has become a custodian of 100 shares.
Correct. It becomes a custodian of the 100 shares.
And that 100 shares will now be issued to the employees.
Correct. So whenever an employee exercises the shares, he basically buys it from the trust.
So when he buys it from the trust, he actually pays money to the trust.
He actually pays money to the trust. Now, when he makes payment of money to the trust, he will be paying only the exercise price for the particular share. So say, for example, it is 10 rupees that is available with him. That's what he will actually pay to the trust. Now, the trust has already bought it at 500 rupees and sitting with the number of shares. Okay. So the cost price for the trust is, the cost price of the trust for those 100 shares that it has got is actually 500 rupees. Now, the employee has a trigger event whereby he has to pay the excise price. Now, for him, he is actually not paying directly to the company, but he is actually paying to the trust. Now, what he pays to the trust will be only rupees 10.
Yeah.
Okay. But
so and it will continue to hold this money, and it will not actually settle it against the liability.
It will not settle against the liability. The liability just keeps carrying on. So now the employee is actually paying rupees 10 to the trust. Now trust has to make a transfer of shares.
Okay.
To the employee. Now the employee exercising is a separate event under the Income Tax Act, where he gets shares directly or indirectly.
Correct.
Okay.
And
this is under 17(2).
Yeah, even though the trust has actually transferred the shares belonging to the company to the employee, it will still be the responsibility of the company itself to withhold the tax based on the FMV on the date of exercise and all of those things.
Yes, yes. Now, when the trust is making a transfer of shares to the employee, then he is going to pay only 10 rupees to the trust in order to exercise those shares.
Okay, and he pays a huge perquisite tax, and that becomes his cost basis.
That has become his cost. But the trust is a separate entity because the trust is only holding the shares.
Yeah. So assuming that this is the only transaction and the trust gets bound up. At some point in time. So in that case, what happens? So there will be, let us say, this transaction where there is 100 shares, he has paid 10 rupees. So there is the company's on one side, it is 500 into 100, which is the liability. And on the other side, it is actually sitting on an asset of 100 into 10. So in that case, what will happen? So when the trust gets bound up, so it will actually
we'll address the first set of the transaction. So where it has got 500 rupee worth 100 shares, it has got. So employee X is actually exercising his 100 shares. Now that 100 shares, for that 100 shares that is being paid to the trust, he'll be paying only 10 rupee per share. Okay. But the trust will have to make a transfer of shares to the employees. Now, trust is considered a separate entity. It will be an indeterminate trust. Because you don't, the beneficiaries are employees and the company at large. Now, the trust will be it will be receiving consideration of only 10 rupee per share. Now, because it is an unquoted equity share, there is an immediate trigger under 50 CA because 50 CA doesn't provide exception saying that if it is trust for the benefit of the employees, it is exempted. It doesn't have a specific call out.
Okay.
It has to make, it will,
So in
it
that
will
case-
immediately be a deemed consideration in the hands of the trust.
As per Rule 11 UA.
As per Rule 11 UA, because you'll go to
Valuation.
50 CA, you will have to see what is the value of the shares, and that will take you to immediately Rule 11 UA. Now, if the
Okay.
Rule 11
So now-
UA is like negative and you don't have any issues, then you are okay in terms, because you're getting a higher consideration for the transfer and there is no what do you call 50 CA trigger. But if the value under Rule 11A happens to be higher than the 10 rupee, then there is no option for you to escape. And the trust will have to pay deemed consideration for that 100 shares it is transferring.
Capital
Say,
gain
for
tax.
example, so there is no escape. You will have to take it as deemed consideration and discharge liability under 50 CA.
So let us take numerical examples here again. So let us say it is 30 rupees is what is Rule 11 UA. And so 30 minus 10 will be what will be in the hands of the trust, which again will be borne by the company. Because again, the
That
company
tax liability, where does the trust have the money to fund it?
Correct. So which will be borne by the
Borne
company.
by the company.
And on the other hand, let us say as per FMV, it comes to say 500. So 500 minus 10 is what actually will be paid by the employee as perquisite.
Yes, as perquisite in his hands.
Yeah. So there is some sort of a taxation to that extent
Tax
of the 20
leakage.
rupees, which will
Yeah.
be, it is the same event, tax has been collected by the government, twice.
Yeah. So this is one anomaly with regard to trying to do trust for a unlisted entity.
Kusum, one more challenge is also there. 500 minus 10 is a tax, perquisite tax in the hands of the employee. If the Rule 11 UA becomes 100 rupees, because it will not be 500 rupees, then 100 minus, then trust has to pay the capital gain tax. No? Is it right?
That's what it is. 50 CA is nothing but capital gains tax only, because from the time it has started
Okay.
holding
What I'm saying
this
is-
thing,
No, what I'm saying is, I agree. FME calculated by merchant banker for tax perquisite purpose 500 rupees under DCF method.
Correct.
FME calculated, NAV is calculated for 50 CA purpose Rule 11 year 2 or 1. It is a book value method. It will not be 500 rupees. It may be say 100 rupees.
That is what I told. 30 rupees is what I gave as an example. Rule 11 UA is only 30 rupees is my example. I told 30. So 30 minus 10 on 20 rupees, the trust will have to pay the taxes. And again, it will be long-term capital gains tax or short-term capital gains tax, depending on the period that the trust has held the, shares. Is that understanding correct,
Yes,
Mythili?
correct. Yes.
No, but it is not beneficial. One way company has invested, made
It's a big headache. It is certainly not beneficial.
But promoter is getting money in this case for transfer of shares.
Transfer, because the promoter would be probably an exiting promoter. See, there are
Promoter has
promoters
actually pulled out the money from the company through the trust.
through the trust.
Correct.
They don't have a secondary option for buyback of those shares. So they are having a trust where they say, we will at least repurpose the shares in some way for the employees in future. So they don't want it to go out, and hence they would have said that we don't want to dilute or give everybody else shares. For subsequently, we'll repurpose. Let's avoid the dilution, and hence they would have parked it under the trust. Otherwise, if they do a buyback, everybody else will go off that way.
Yeah, ultimately, doing all of these things, ultimately the trust will be a vehicle which will be, which will actually be responsible. Assuming for a minute that if the trust gets wound up, then the losses will be booked by the company. So basically, trust will be responsible for booking the losses at the time it actually, at the time it winds up, and the company will simply book the losses, because all the while any money that the company has advanced to the trust, it will show it as a receivable. At some point in time, when the trust will no longer exist, and there is no scope of the company receiving the money, it will actually book it as a loss.
Correct. It will just book it as a write-off. There is
But
no other option.
Instead of this complication, better simply they can go for a buyback with that exiting promoter, let company pays, so that it will
But it will not work like that, no, sir, all the
Sir,
time.
most case, one particular case we saw, they didn't have an option because they had created the trust in order to say there is a park out of funds. And they had to use the shares that was sitting in the hands of the trust.
And see, another thing, buyback means you cannot have selective buyback. No, buyback means you have to give the option to
No,
everybody
no,
to buy.
no. Selective buyback. You don't say selective
Everybody
buyback,
else.
but no. You don't say selective buyback. But you will do the selective buyback. Example, assume that you have 5 shareholders. You want to buy shares from X. What you will do? You will give on the prima facie offer to all the shareholders. Other people keep
Will
quiet.
reject.
Will offer. Will
No,
reject
but
or will keep quiet.
yeah, it does.
No, that is 100%. That is otherwise the buyback will not work out.
Yeah,
Because
all these will happen if there is a thorough understanding between all the rest of the 4 of the shareholders. No?
Shareholders.
But if
Correct.
there is no understanding and everybody wants to exit, then it will
sure.
not work out.
That is correct. It's only understanding with the consent of all the shareholders.
Correct.
In one of the case that we did, the double whammy was that if we do a simple 11UA calculation for that, and if you go exactly as per the value, the buyout was at say 10 rupee, which was the excise price for the employees, and the value of the 11UA, if we do the formula, was somewhere around 180 rupees. Now, we were literally at loggerheads because there is no leeway under 11UA for interpretation of what you call fully diluted basis. Income tax basically doesn't consider the concept on a fully diluted basis. It says only value available to the equity share, and they had huge CCPS which is raised, and the entire premium was sitting towards equity. Now, if we have to write an opinion, we can't say it is contrary to law. We can't say you take it based on fully diluted basis. But operationally, the client said that we will fight it out because this is just a stupidity of law.
Absolutely,
And they said we will get a value. I said, okay, you do it, and there is a litigation possibility here. Just be cognizant of it. If you can get a fully diluted basis 11UA, then it wasn't that high. It was say 13 rupees. There was exposure only to the extent of 2 rupees. But if we had to do it through a exact what do you call rule 11UA applicability, the value was quite high. And there was nothing much we could do. We said that you pray to God and please go ahead and execute. He said we will convince and we will get it. And we actually inquired around with a couple of big fours also. They said that this anomaly we accommodated through providing 11UA on a fully diluted basis.
And that's a very, if it is CCPS, it is okay. But what if there are, OCRPS and all of those things? In that case, I think that should not be taken into consideration.
Correct. Because OCRPS, at any point of time, you consider equal it to debt. Correct. See, even if there is an inkling of debt, then you can reduce it. So at least to that extent, I am safeguarded. It's only with this hybrid instrument, which can be equated with the equity, we have the trigger point. And we need to be very careful.
Yeah, and in this case, if there are CCDs also, that will also be considered, right?
Yeah, but CCD is, at least CCD, you can consider it as debt. Though by nature under FEMA, you treat it as part of equity, it is still debenture.
Okay, so assuming in your example, where if the company had both CCPS and CCDs, would you have restricted, considering the calculations only for equity plus CCPS and ignored the CCD? Or would
yeah,
you
I would have ignored the CCD and done that adjustment only for CCPS, because CCD it's still debentures. So debenture can be considered as part of liability of the entity.
Even though it is, of course, I
Even
think
though
you have to just go through the terms of that agreement. If there is a liquidation event and all of those things, and if we say that prior
there
to
I will have a trigger more from FEMA perspective, where there I will have to consider on a fully diluted basis. But under income tax, debenture is still considered as liability, though it is a compulsorily convertible debenture to future. But debenture, you park it per se as only a debenture, no? At least there I can reduce that value. But CCPS, there is no specific call out. Where do I reduce it from?
Correct. Okay.
So, a lot of people actually do it based on fully diluted basis. So, this was an absolute headache when we were doing it, implementing for one particular client. We actually told them, please don't, after that particular example, we said that please, if you are a unlisted entity, don't do this circus of a trust route.
But what happens in case of a listed entity? Then what happens? Even listed entity also, there will be a pool that has to eventually get transferred to a trust.
But listed entity, you can go buy shares from outside. and you sell. So generally there will not be this anomaly of difference in shares. It can still go buy and purchase and sell shares.
But again, funding again has to happen from the company itself, irrespective of it. It is just that there will be a pool of money that will be given by the company to the trust, and the trust will then operate by buying the shares from the market. And then everything else.
But still the funding happens.
Follow.
Yes.
But even Revenue A will follow, everything else will still follow.
Yeah. But the only thing that if it is a market mechanism, then this 50 CA trigger will never be there.
Okay.
This deemed consideration under 50 CA, that trigger will not be there for you.
Okay.
So I will just 1 second, just give me for me to share the screen. Apologies, sorry. I was just trying to pick up a share screen. Just hold on. Yeah. So stepping into the valuation side, I just want to dwell on two aspects. One is the guidance note prescription with regard to the valuation, which happens either in the form of an intrinsic valuation or an option pricing methodology. Now, guidance note generally provides for intrinsic, but as a mechanism, I think practically everybody goes through the fair value method for valuation of the options. Now, generally, because the compliance of the measurement comes out as a result of an accounting standard, we generally say that pick up a valuation from a registered valuer. And in case if it is under any other, say, US GAAP or IFRS, then we say any professional can also do the valuation. Now, valuation predominantly we have used as part of our valuation exercise. We have seen the Black-Scholes model, which we have extensively used. I will try to correlate from the scheme onto the valuation requirements so that there is a little more understanding. So what are the main aspects that we actually pick out from the scheme as part of the transaction is that what is the excise price that is provided as part of the scheme. And second is that when we generally make an approach towards valuation, we generally pick out the entire grants that has been made during the year. So we have the list of employees and what are the different dates on which the grant has been made and how many options has actually been granted to the employees as part of the transaction. Now, after that is the trigger with regard to the time to expiry. Now, for each of these, on the date, we pick up what is the grant date and we pick up the risk-free rate of the particular, for that particular option calculation, we pick up the risk-free rate on the grant date for each of the grants that has been provided. The volatility, we generally do it on two forms. One is that we generally pick up either the sector-specific volatility where we can particularly mark that particular company and pick up a sector, then we pick up comparables for that particular sector, other comparable companies and see what is the volatility. In one of those, in some of the startups where there is no specific comparative, then in order to provide some form of a volatility, we say that the volatility at least will be marked to the particular, what you call, we take it as part of BSE index. I would like to get a view with regard to members as well. How do they generally pick up volatility? This we use it as a basis. My concern with regard to taking volatility as BSE for only reason happens to be that sector specific volatility actually gives up a higher. If the sector is actually performing better than the index, then it gives a better value for my option. But if it is BSE, then the returns for BSE over, say, a 10-year period or even 25-year period, it is not very substantial and it comes up only to the extent of 10 to 12% or 15%, which is not actually how the sector actually gives. Sometimes the sector volatility is as high as 40%. My reason why I actually had to concentrate on this particular aspect was that generally the valuation of options is a trigger in order to recognize the expense of the books. And the way the ecosystem functions is that the value which we take up for any of these companies, if it is a mature company, then the increase in volatility or how you estimate the stock to actually perform, the option value to increase is actually is more in line with the general trend of that particular company. If it is a very disruptive company and I'm able to pick up something here, it is not actually matching to what I book as expense. So if I say the option is having, say the value of the FMV of the share is say 300 rupees today and the excise price is 10 rupee. Now 290, and if I do an option valuation based on this, that 290 number doesn't move much. But the funding for the company which happens in the second or a third round is actually much substantial. And the value is actually quite high. Now, if I take a very minuscule volatility, it is never reflective. So is there some mechanism anybody has adopted to, plug it? Any specific thoughts in terms of that particular area? Because for me, my expensing is generally restricted to what I actually book as expense. So today, if I book the value as 300 minus 10 and I'm restricted to that. So that is where my trigger part of it actually happens. So these are the main items. If anybody has any particular thought in terms of how do they do specifically for volatility, it would be useful. But I generally prefer the sector specific volatility because it gives a little more it captures the increase in the value of the particular stock as compared to any other particular case. So I'll move further. In case somebody wants to add on, please do. It will give me a little more insight into this. Now, as I said, lot of the main aspect that comes from the scheme document is in terms of excise price and the life of the option, then the time to expiry. I'll dwell a little on the time to expiry because it has a huge impact on that. We have a lot of cases where the value, the option vests at different time periods, say in tranches of 25% over a period of first year, second year, third year. There are a lot of tranches that we have. Now, how do we determine the time to expiry? Now, the time to expiry is from the time what is the time to expiry for the particular option, which is actually from the time of grant, which is whatever is the 1 year or 2 year time frame, plus what is the possible time frame from the vesting up to exercise period when the option can actually be exercised. So we generally take it as a mechanism where we say, if it is a simple case of say 4-year vest, then it is the time to expiry for the option is that first 1 year, say 100 options we are valuing, that first 100 options gets vested at the end of the 1 year period. So we take 1 year period and say that the excise period is roughly around 8 years from the time of vesting or from the time of grant. Then we generally pick it up as from the 2nd year up to 8th year, the particular person can actually exercise at any point of time. So we generally take an average between the 2nd to the 8th year and say we draw out at say 8 minus 1 and 7, so 3.5. So the time to expiry could be 1 year plus the 3.5, which could be 4.5 years. It might take for the person to actually exercise. This is of course taking sort of a median between that particular range, saying that it will be after 1 year, but could be any time. When we come to the second part, which is where a tranche is actually getting exercised at the 2nd year, we say 2 years plus whatever from that 2nd year up to 8th year. So we generally, it already has a time frame. So it would be 2 plus whatever is 6 minus 2, which would be say 4 divided by 2, say 2. So we say 2 plus 2, 4. So in that time, it is very important to determine a time to expiry for the different options. So this is generally an estimation and what we perceive as possible time to expiry for that. It could also, having said that, a person might issue, whoever has been issued the option can actually exercise it immediately or at any point during the period up to 8 years. So there are also cases where we have seen people have 0 exercise period, where it is like very open and we don't know how do you estimate the time to expiry. There we have generally taken as 10 years as an average period by which a person generally exercises and seeing how the company has also worked. Then we take those kind of softer information in order to determine what was the time to expiry for those kind of options. So this is something that we generally do as part of practice. Now, so for us, the key trigger item which actually determines the value of the option is one is the time to expiry, which actually varies for each tranche of our option based on the vesting period. And the other one was the expected volatility, which kind of is constant across all options. We say that for all options based on this sector, this is the volatility that is expected. And based on that, this is where will be the value of the option. This is we generally know there is not much into the Black-Scholes because it has already got a good recognition and it is a formula driven exercise. So it is how we capture the different aspects of the formula in order to arrive at the value of the option. Hence, this is what was generally considered. This is the calculation I've taken for comparable companies, how I determine the value of the, the delta with regard to the comparable companies. So this is the mechanism I determine the volatility of it. I do a simple median or generally an average. Usually we take it as a median to arrive at the combined volatility across different comparable companies, and we pick up that as the value. Now, this being said, with all three scenarios I have given for an option with a different time to expiry across the period, now how the option value generally changes. So the option value goes through a change based on the time to expiry. The longer the option stays vested, then the value actually increases. Now, this is a very commonly used methodology across most of them. They generally say that this can be used only in the case of a European option, because the exact period of time is fixed, and we generally don't use it in terms of an American option. But to some extent, I believe that we do that adjustment for what is the time period for exercise of that option through averaging it in terms of ascertaining what would be the possible time to expiry. And there we generally make an adjustment in order to arrive at the value of the option. So more or less it sort of covers, even though it is for that, it is for a European option, we make an averaging with regard to and make an estimate on the time to expiry, as a result of which the value of the option gets adjusted. So this is one thought process that we have. Apart from this, we also do, we have as a binomial tree that we actually can adopt. And this is having two different certain paths where we say that the underlying asset can either go up or go down, and what would be the value based on that. Now, when we did a binomial tree will always have an up and down movement, whereby it takes into account the probability of exercise of that particular action happen. And then you pull it to the current present value for determining what is the value of the option. Now, doing a binomial tree for a similar option, what we had done, I had taken the same value of 200 rupees as the stock price, and 10 rupee as the exercise price over an average period that I had got, which was roughly around 3 to 5.5 years is what we had considered. For that particular option for a 5-year period, the value of the option is roughly around, call option is roughly around 192. I will just share the workings of how I had arrived at these two cases as a separate Excel to share on this. So if I consider the value as per BSN, then it is roughly around 191, 193 or 195 depending on time to expiry. Now, for a 6-year time period expiry of the option, it is roughly around 193. And in this case, it is roughly around 192. Now, we tried with a Monte Carlo simulation model, which is again a simulation. And the simulation for me so far, the kind of ESOPs that I have received and I have worked on is that usually we have only the service period as a major item which undergoes a lot of change. So again, Monte Carlo, we work it as a different time period to expiry that I had taken. And based on a Monte Carlo simulation where I run a binomial model for each kind of scenario, then the randomness provides me with a median, which is roughly around 191. So this was my observation across those three methods. So most probably we all generally use the Black-Scholes as a easy recommended method for valuation. And I have not seen any other case where any other alternative method has been used. If anybody has any thoughts on that, would be willing to understand and find out what is it that you have done.
The binomial, how did you calculate? We need to calculate this volatility. Can I go to binomial?
So I had actually picked up the same volatility, sir, because I had taken the volatility based on roughly around 20% or something as 24% as the volatility. I use the same volatility. So that's why I said between binomial and this, the volatility being the same and only the time to expiry having an average difference, the value was more or less the same. But I had taken the same 24% as volatility.
Oh.
Any different thoughts with regard to binomial? Anybody has used binomial as a practical experience?
No.
Because generally, people come to, generally as part of finalization, they come as compliance factor where they say that, okay, we need a ESOP valuation. What is the value? How much is the accounting to be done? And they generally pick up the value. There is not much thought process except for the basic parameter thought process as to how we have arrived at different aspects. Nobody generally deep dive into how is it the value that you have taken. So it is generally an accounting entry. So I just wanted to check, is anybody has used anything specific? If not, then yeah, I draw to a close, and any other questions you want me to field, I'm happy to take it up.
If possible, the N D1 and D2, how did we calculate? Just can you explain in a brief, if possible, time permits? Black squirrels are N D1 and D2 before. Yeah.
This is basically out from the formula that we generally apply, how we take the ND1. So is my screen visible or?
Yeah, visible.
You can see my Excel?
No, this
Okay.
slide is there.
One second, just hold on. So ND1, this is the formula that we use. One second. I'm just picking up a worksheet that I have in order to just take you through that.
नीचे जाती वो साफ है ना खोलने वाला नीचे मेरा ऐसा कर रहा है ना साफ कर नहीं
Okay, so here we have, this is the formula that what we have taken. We have taken ln, which is log normal return for E6 by F6, which is the stock value by the strike price. Plus, this is the formula that we have arrived, which we have taken the risk-free rate. Then, which is the volatility. Here it is, we have taken as this thing, which is 24% is the volatility I had taken. Volatility, and then we have taken the square root of the what do you call L6, which is the time to left for maturity. I can share with you this particular thing, which is basically a derivative from the formula that we already have as part of the Black-Scholes. It's just application of that particular formula to arrive at the value.
Sure, if we can share this sheet.
We'll certainly do, sir.
Yeah, hi, Mythili, one more question. Yes. So what we have discussed in the trust route, okay,
yes,
that either the company or the promoter will transfer the share to the trust.
Yes.
So in this case, the company who is basically whose shares are being allotted as ESOP to the employees will not be able to recognize as an ESOP expense any amount, right?
Last part, can you repeat it, sir?
So basically, the company whose shares are being allotted is ESOP, if they would have directly issued this to the employees, they would have been allowed the ESOP as an expense. But if they are going through trust route, does it like that they will not be allowed only any expense of ESOP?
No, sir. Sir, that allotment, see, you are given ESOP pursuant to a scheme.
Correct.
Okay. And that is a trigger point for you. And when you grant it, is a trigger point for you to actually provide for it as expenses. Now, trust is a means for settling it.
No, but what I'm into say is, for example, there are two routes. One is either promoter is transferring the shares to the ESOP trust. Okay.
Trust.
So
Okay.
there the trust is already paying to the promoters.
Correct. Yes.
Okay. And in the second option, if the company is issuing new shares, then also the trust is paying to the company for the issuance of the shares.
Company. Now, can you restate that particular question?
Yeah. So
First
for
is
example,
first is the case of.
I
first
think
case is
I understood the question Mr. Sagar would want to
yes.
understand. So
Yeah.
what he's asking is, in case of a trust route where the trust is acquiring shares either by a from a promoter, or it is
Yes.
subscribing to the shares of the company,
Yes.
upon exercise by the employees, will there be any expense in the books of the company?
Yes, correct.
There is no expensing in the books of the company because
Ah.
the allotment is the transfer of shares is happening by the trust to the employee.
Correct.
Got it. Got
There
it.
is no expense in the books of the company.
So company will not be having any ESOP expense only in their books, right?
You're right. Yes.
Okay.
This
Got
is
it.
direct allotment by the trust to the employee without as part of scheme.
So, sir, I just want to understand then why the listed companies, because if they are generally, this is a pure expense of their employee expense only, then why they are going through trust route if they are not getting allowed any expense as part of the deduction in their income tax? What is the really objective of going through this? Because the trust route is anyways complex, and plus they are not getting any income tax deduction as well. Then what is the objective of these guys going through trust route?
Yeah, it's a good question, Mr. Sagar. Even we will analyze this and come back. But there were certain rules around ESOPs long back.
Okay.
Rules. If you look at that Infosys matter in the past, I think there were
Yeah.
some guidelines provided.
Okay.
We will certainly examine this and we'll come back to you.
Okay. Thank you. Thank you, sir.
Thank you.
Any further questions?
I think no question. You answered all. During the presentation itself, we covered all the points.
Looks like we have come to the end of the session. Participants, it appears to me there are no more questions, correct?
Yes.
Okay, so I will take this opportunity to extend my vote of thanks to Ms. Mythili as well as Mr. Arun. There is a saying, which says that risk comes from not knowing what you're doing. So I think it was, Mythili as well as Arun have given us an extensive outlook on ESOP schemes. So, there was a risk that we all valuers were carrying by not knowing. But now with, Mythili's excellent deliberation, I think we have a very fair understanding of how to go about, what are the, what are stock options, what are the types of options, what are phantom stock options, SARs. I think we have dealt and understood all of these aspects. And of course, today's session was extremely good. We have understood about the taxation aspects. We have understood about the valuation aspects, and more than that, we have also understood about the nuances about the nuances relating to really having a trust or not having a trust. I guess I know this has been a very, very enriching session. Thank you very much, Mythili and Arun, for your time on this matter. Your PPTs have been very comprehensive, and your the manner of deliberation has also been very excellent. I'm sure all the participants who are participating in this morning session acknowledge the fact, and I, on behalf of Bangalore Valuers Association, I thank you both for your time on this matter. We are very grateful to you for your knowledge sharing. Vijaya, will you be able to present the mementos to them?
Thank you so much. We got the mementos and we are very happy to receive them. It was very beautifully wrapped and packed. It took at least 5 minutes for us to unopen the whole thing and take it off. Thank you so much for this. Great pleasure being part of this, and I have personally been enriched by Bangalore Valuers Association in the past, and I'm happy that I had this option for contributing back. Looking forward to more such enriching sessions. Thank you so much. Personally, there's been a lot of knowledge share and a lot of takeaways from sessions. Thank you so much. I look forward to that 7:30 in the morning. So keep up the team for taking it forward.
Thank you very much, Mythili. Thank you all the participants for having participated in the follow-on session today. And we look forward for your participation in the residential course that is happening next month. So if you can, we can also talk to Mr. Ravindra, and if there are any open slots, I guess if there is an opportunity, we request you to kindly register and participate. It will be a great learning process, because it's going to be a hands-on experience session. Thank you so much. Vijaya, can we please end the session?
Yes, ma'am.
Thank you.
Thank you very much. Have a good weekend, everybody.
Thank you all.
Thank you all. Bye-bye.
Bye-bye.